Hello and welcome to another Crossroads Consulting XR Insights. Crossroads Consulting helps companies outsource, grow, and protect their assets. We're your hosts, Jeff and Billy Rhodes, and today we have a very special guest with us, Kirk Robbins with Strategy Partners Group. Welcome, Kirk.
Thank you, guys.
I've only gotten to know you recently here. Jeff spent a long time with you and speaks very highly of you and some of the areas that we talked about where you help companies. And these are some broad areas, but I just want to make some key points here with operating and investment capital, acquisitions as a strategy to grow, creating enterprise value, and then ultimately an exit strategy. So I know those are some of the areas you guys specialize in, but if you would, just give us your background a little bit and tell us about Strategy Partners Group.
Yeah, thank you, guys, and thank you for the opportunity. I've been in business a long time, about 4 decades now. Have worked at an executive level with a number of firms. Started out my career as a budget officer in the Marine Corps. I actually was the budget officer for the 2nd Marine Division, which was a pretty sizable budget to manage. Had a staff of about 22 people as a very young guy. I got introduced to the government contracting space during that cycle, and that served me well in my career. Since getting out of the Marine Corps, I've worked in the real estate industry. I've worked in government contracting, IT, outsourcing, as well as software development. Extensive background. I've been a CFO for a company as large as $1.5 billion of revenue, managed acquisitions, about 17 of them in total, to help each of those companies that I worked with maximize the value. During an interim period between jobs, I actually took an assignment from the bankruptcy court in New York that was dealing with a fairly substantial $500 million company that was in bankruptcy, worked as the trustee to sell those assets out of the bankruptcy. So a wide range of experience in my career.
Tell us about your firm, Kirk, and this is why I wanted to take a little bit deeper dive into your background, because I mean, you've traveled the world and you've done some things with very large organizations and even small localized companies. But tell us about the people you have in your firm and just quickly some of their credentials.
Yeah, so we typically, from a business size, we most typically operate with businesses between 10 and $250 million. We do work with larger ones as well. I have clients with revenues up to 20 billion, and we do advisory work for them, optimization work for them. Our partners, similar to me, have long tenures as operators. We like to say that we are strategic partners and strategic operators, because we've sat, all of us, for long periods of time in the C-suite, in those chairs, making all the same tough decisions that our clients have had to make.
And a lot of times private equity will parachute you guys into companies that they may need help with, or they need additional strategies, or they don't have the internal resources to carry out the financial objectives.
Yeah, and I can give you one example real briefly here, but we had a client that was a private equity group. They did 3 acquisitions in a 6-month period. The combined revenues of the company when it was fully executed far outweighed any business operating experience that any of their managers that were in those companies had. So we did a variety of things for them. None of those operators had integrated businesses either. So we were brought in to create the integration plan, to integrate the 3 businesses together, to train the folks that they had selected to be the C-suite for the combined entity, and we brought them up to speed. On the finance side, they didn't have a person internal that really could handle the new size and scope of the business. So we helped them to place a CFO as well.
Excellent. Excellent. Well, let's talk about business in general. You've seen highly successful businesses and you've seen businesses struggle, even go out of business. Give us your thoughts on, I don't know, let's cut it down to the purpose of starting a business.
Yeah, it's a great question, Jeff. The thing that we see a lot is that people get caught up in the daily operations and they kind of lose the original focus of why the firm was started. And all businesses are created for one reason, and that's value creation, to create wealth for the stakeholders of the company, whether that's a publicly traded company or otherwise, whoever those stakeholders are, it's intended to create wealth for them. And as a matter of fact, 65% of all businesses that start in America close their doors before they reach the 10th year. So, and that relates back to that. They kind of lost their direction from what their original vision was. So that's what our firm does. We're an advocate of the ownership group. We come in, we act in some ways as a force multiplier. We bring our decades of experience to the team, and we can bring in that large and small business and all those perspectives that they might not have in some of the businesses at the $10 to $20 million range. We can bring in a CFO or a CEO person that has sat and operated large scale companies, created the efficiencies, that kind of thing for long-term benefit of companies.
So Kurt, I'm sure there's many reasons why these companies fail, but what are some of the top reasons that you see that these businesses will fail within 10 years?
Yeah, well, what I see more than anything is just lack of either a strategic plan or lack of focus on that strategic plan. Strategic planning is critical to sustain success in businesses, and companies, actually, a lot of them do a very good job at creating strategic plans, but their operations don't align with those. So they have them and then they don't carry through on those or translate those into policies, procedures that ensure the focus on reaching those strategic goals that are created out of that. We also see communication as a big issue. So we've all been to those meetings where you have 4 to 10 people in a room, and a lot of times they come into the meetings and not sure exactly what the meeting's about, or they're not focused on what the problem is and so on. So that communication, we work with clients that have that kind of issue, and we make the people that are in the meeting part of the solution. And we ask them to find the solutions because, people that might just think they're coming to a meeting to just attend don't contribute and they don't carry out that strategy. But if you make them part of that solution and have to carry it out to the others in the company, then they're invested in the solution and they're invested in the meetings, and the resulting outcomes are quite remarkable.
We've been doing this quite a long time, all three of us. A lot of the companies that I've seen in the past, that the owner has a pretty big ego, he's pretty proud of his company, and you start to see it just status quo. The ones that you see bring in a coaching team have seemed to really just project themselves up the ladder there and become even more successful. So see a big need for coaching out there.
Yeah, coaching is important. Different perspectives as well. So one of the things that we bring in, for example, is we've seen a lot of industries. We do consulting, so we see operations from a lot of different areas. We see industry best practices, and we see things that might apply to a business that they don't see in their industry, and bring in those efficiencies that might bring your net income. Maybe you're doing 10% and it might raise it to 15%. And that's without generating any additional revenue. So those fresh perspectives, those industry best procedures and policies and that kind of thing can really make a big difference to a company. 10% is a great income, but 15% is a heck of a lot better. So,
And I'm sure that helps with a lot of the cash flow, which I know is one of the areas that you help companies with.
yeah, exactly right. And you know, I'll say with cash flow, there's a couple of things about it. One is obviously operating the business efficiently in terms of DSO, days sales outstanding, and that kind of thing. Your order to cash process is being good, but also leveraging your assets and making them worth the most that you possibly can. There's underutilized assets quite frequently in businesses, and we help to leverage and unlock those assets to generate more income with the same assets that you have in the company.
Do you guys use different types of methodologies in your evaluation of a business? How efficient is it running? How effective are they with their cash flow, their revenue? Because obviously there's a lot of money coming in, a lot of money going out. You know, you guys are the financial wizards. What types of methodology do you guys provide?
Yeah, we have a methodology that we call Thrive. And the intention is to take a business that's just getting along, or maybe you know, doing okay but isn't thriving. We focus our methodology on changing and transforming that business to be able to thrive. As I mentioned a little earlier, taking a company doing 10% net income and maybe moving them up to 15%. And we do that looking at 4 areas. We look at the strategy and vision of the business, make sure, and of course the business owner knows what that is. But there may be things going on in the industry, for example, that they don't see, that we see, and we can tell them and help kind of hone that strategy that they have and vision. We look at people resources, biggest investment of every company. Do you have the right people? Do you have them in the right seats? That kind of thing. So make sure communication throughout the company, even if you have the right people, if you're not communicating your plan to them, it's very hard for them to execute it. So working on the communication piece. We look at leveraging assets, both tangible and non-tangible assets, to maximize market opportunities out there. So that's certainly important to it as well. And then execution, just simple execution. Let me give you a case in point. So you're operating a company, and that company is doing pretty well. You know it can do better. But maybe your financial statements and your financial processes aren't timely. You might get financials 15, 30 days after the end of the month. Obviously, those financial statements are intended to help you to operate and make business decisions. But if you think about it, what you're looking at from a financial perspective for, let's say, the month of March, you get the financials at the end of April. By the time that you get those financials and you make a decision, conditions could have changed. So you might be making a decision that's not timely, and it's not effective. So how can we put real-time financial information or assist companies in doing that so that they're making real-time decisions? So interim financials during the month. This is our goal for the month. At the mid-month, where are we at? Are we close to our KPIs? And if we're not, then I can make a decision that has time to make a difference before the month ends. That's the kind of operating procedures and optimization that we try to provide clients.
You know, you've told us about one of your clients, without naming names, but it's a skilled trade company in the Carolinas. And that's a really interesting story. Is there some thoughts that you can provide us on, you know, this is a skilled trades company. They had some challenges. You guys came in and helped them grow revenues dramatically, and some of the steps that you implemented to help them along those lines.
Yeah, and I'll give you a little background on the company. A plumbing company based in the Carolinas. They were family-owned, long-term, 30, 40-year business. They were a significant player in the market. The father started the business, family-owned, was retiring, had some health problems, and really was going to liquidate the business, sell it, and do that kind of thing. But it really didn't make sense for them to do that. They had a thriving business already. The tax implications of selling the business would have cost the family about 40% of the value of the business. So they brought us in and asked us, what did we think their best opportunities were. They had a decent amount of cash on their balance sheet, and we suggested that rather than selling the business, they were in a perfect position to grow it. They had never grown through acquisition. They didn't have anybody in-house that knew how to do acquisitions. And we provided that guidance to them on what that process looks like, how to target and identify businesses, put together the purchase and sale agreement, work with the attorneys, so on and so forth. That business, since we've done that work, as revenues have climbed more than 50%, and they're already contemplating doing a second addition to the business.
So that's fairly common down here in Florida, where it's a construction mecca. There's a lot of successful companies, but they could be more efficient. They could be more successful. They could increase the value of their companies. And we are seeing a lot of private equity involvement in skilled trades. They execute the roll-up strategies.
Correct.
What are your thoughts on the skilled trades in particular?
Yeah, extremely hot market. It's one of the hottest markets from a private equity standpoint. They're targeting those quite heavily right now. When we work with clients that are on the sell side, we go in and we look at optimizing what that exit looks like for them. So what we try and do more than anything is get their gross profit and their operating profit running in a parallel. If you can do that, and you can do that consistently for 18 to 24 months, that shows both growth and operating efficiency, and that increases the multiple on EBITDA that they get in the valuation. So we can help them grow by bringing in financing if they need financing to do the type of growth that they want. But really, it starts with targeting what they want in the exit, both in terms of taking care of people as well as the number that they want. We help them with valuation. Quite frankly, most business owners don't really have a good feel for what the value of their business is, and that's a starting point. And if it's not what they want it to be, how do we take it to where it needs to be? And we have all the resources to bring in to help assist them to get to where they want to go.
Yeah, that's great. I was going to ask, could you just give a brief definition and explanation of EBITDA for those out there that aren't, too familiar with it, and how it impacts the transaction of a business?
And why it's so important, especially to the private equity guys.
Yeah, so business valuation is used from private equity, who are the largest buyers of businesses in the country, and they use EBITDA as the basis of valuation. And EBITDA is an acronym that means earnings before interest, taxes, depreciation, and amortization. In a nutshell, what it really means is when you take out interest, taxes, depreciation, and amortization, you have the cash flow of the business. It's the real operating cash flow. So they're valuing the business based on the operating cash flow. And that number is very important, both in terms of what the number itself is, as well as the ratio of what that is in comparison to the top line revenue.
Go ahead. Yeah, I wanted to stay on the EBITDA question because a lot of times when a private equity firm comes in, they can do things with interest rates, they can do things with taxes, they can do things with depreciation and amortization. I know you've done some things that we've discussed with sale leaseback transactions. They might have a piece of real estate, or they might have other forms of assets that are really not performing very well from an increasing value perspective. The sale leaseback is pretty fascinating to me, if you don't mind.
Yeah, so I've got a client right now that we're just about ready to close a sale leaseback transaction. They are in the telecom infrastructure business. They're putting up cell phone towers and doing underground fiber work. And they bought a couple of different pieces of property that they have that really don't contribute to that telecom infrastructure business whatsoever. It takes a lot of the time from the management team to oversee those real estate assets they bought and so on. So we coordinated and brought in a sale leaseback company to buy those assets from them, and they will simply then be a tenant afterwards. But all of the cash that they'll get from the equity that they have in that business, they'll now be able to turn and use toward generating more revenue, more EBITDA in the actual telecom business. And so, for example, they were struggling with a little bit of cash flow, and they had opportunities to take on contracts. There's a little bit of material, there's quite a bit of material in what they do, and they didn't have the cash and capital available to take on those contracts. By doing the sale leaseback, getting that equity back, now they can aggressively go after those contracts that they were having to let go.
Yeah, that's interesting. So growing a business could include making acquisitions. What are the mistakes companies make when they say, hey, you know what, I want to start buying some smaller competitors. I want to get into new markets. Rather than grow organically in new markets, I'll just go ahead and make an acquisition. Where do the mistakes occur that you see?
Yeah, so a lot of times they'll look to maybe their attorney, their CPA, for advice on how to go about it and whatever. And while those folks are great resources, most attorneys don't work in the M&A space. Most CPAs don't work in that space regularly. So a lot of times they're looking to the wrong source for advice. Even though they get reasonable advice from them, they're not optimal advice. So I think starting out, you have to find the right way to enter and ask the right people. So there are advisory firms out there that can do that. Ours is one of those that has that background. So, for example, how do you finance it, and where are you getting the financing from? Your CPA likely is not going to help you with that. Your attorney's likely not going to help you with that. But if you bring in that right resource to give you that guidance on, what's going on in the industry, our firm, for example, is very plugged into the PE network as well. So we know what the industry's doing. We know what the multiples are in that industry. And we know all the financing players. So we can bring that kind of unique experience that your CPA or your attorney, your local attorney, might not be able to give you.
Yeah, there's a lot of ways to finance a deal. Where do you see the deals, the potential acquisitions going sideways?
They go sideways. I'll give you a case in point. We had a client that using, again, an attorney that didn't have a background in M&A, doing that purchase and sale agreement. That process took about 3 times longer than it would have with an experienced M&A attorney, just that alone. And as we know, the cost of attorneys is pretty high. So that 3 times the amount of time, we basically the client basically paid to train their attorney on the M&A process.
And time to market is key, right? I mean, you got to be able to
absolutely.
react.
Well, absolutely. And every day that you haven't closed it, you're committing more capital resources to it, and you're not generating any revenue that you would have gotten had the deal closed three times faster.
Yeah, exactly. You and I have worked on some telecom infrastructure deals, and what we run into, the operators may be really good at operating their business, but man, when you start diving into their financials, they're in disarray. Some of them are just completely dysfunctional. If you're going to look at either exiting or making an acquisition, how do you prepare the financials, and who would you suggest using, maybe even Strategy Partners Group, to work on the financials, whether you're buying somebody or you're looking to exit yourself?
Yeah. Our team does that a lot. And Jeff, we've worked with a few companies doing exactly that. Financials are critical to any deal. First, in terms of the valuation, if there's not comfort level in the accuracy of those financial statements, then your multiplier on your EBITDA is going to go down, which means the value of your deal is going to go down. If those statements have never been audited, and depending on the quality of your financial person that's in place, again, there's a lack of confidence. Anytime that the risk profile grows, the value that you're going to get for your company is reduced. So getting those done correctly, timely, that sort of thing. When we come in and help clients with that, we know exactly what the PEs are looking for. We know what kind of due diligence they're going to do. And we not only get the financial statements up to speed for the client, but we're also working on, we know what needs to go in the data room. So we'll start preparing those packages so that process can move smoothly and quickly when they get into that M&A stage.
You mentioned a word, risk. Think of it from this perspective, and it just kind of, a light bulb kind of came on for me. The buyer is buying risk. Yes, they're buying a business, they're buying a successful business, but they're also buying risk. That's why the financials, look, even if you do an internal, you have a good CFO, right? And you put together some pretty good financials, the buyers want to see audited financials. How does that play into the equation?
Yeah, again, you can close a deal without having audited financials. It will definitely impact the amount of value that you get out of your company in doing that. If you have to go out and get an audit, obviously that's going to delay. Typically, especially if your company has not been audited before, you're looking at anywhere from 60 days to 6 months to get an audit completed. And typically, and optimally, you would have 3 years worth of audited financials. So if you haven't had any done, now you're looking at potentially 3 times those amounts of time to get that done. The other thing that happens is during the exit process, the buyer, whether it's a corporate strategic buyer, whether it's a PE, whether it's a venture group, whomever it might be, they make an assessment of the management team. Obviously, they'd like to keep the institutional knowledge in place and optimally run that and continue to run the business. So what happens in that process is the management team may go through a series of what we call road shows, where they go and they sit across the table from the buyers and they go through these question and answer periods. Again, they'll test their knowledge about the operations of the business, how well do they know the financials and how those things are driven, that kind of thing. So we also do prep with companies and management teams to get ready for those road shows and that exit process.
I'm sure the first one would be a little nerve-wracking for businesses.
Well, yeah, and strategically and quite frankly, we'll assess the quality and veracity of potential buyers. and we'll pick the one with the lowest potential of actually making the acquisition and select that one to be the first roadshow, and get maybe one or two of those in where they've gotten a chance to experience and get more of a comfort level with it. And then when we hit stride with those real potential buyers, the ones that are most likely, then they have a little seasoning behind them as well.
Sure.
I was at a ACG event, I guess it was about a year ago, and there was a roofing company business owner from the North Carolina area. He had grown his business really well, moved into multiple states, was looking to expand into Florida. And he's getting a lot of people, a lot of private equity firms knocking on his door. And so he started to engage them. And he tried doing this all by himself. And he said the amount of time that he spent on going to all of these conversations with private equity, et cetera, it detracted him from running his business to the point where his revenues really started to decline. He says it was one of the most expensive experiences he's ever had, but he did finally sell to private equity, but he tried to do it on his own. And it was just, he said he'll never do that again.
Yeah, I think and that's a big risk in the exit process. The ownership and the management team becomes so involved if they're doing it themselves in that process that they don't have time to operate the business. And during that acquisition process, you're continuing to do updates to your financial information. They have what they call TTM financials, trailing 12 months. And if that financial performance is going down as you're going through that M&A process, it will also bring the value of your business down. So they're not efficient, typical businesses, because it's not what they do normally. Most businesses, the acquisition or exit that they do is the first entree into the M&A space ever. So bringing in outside resources to manage that, if they stay focused on growing the revenue and the EBITDA, that's their best case scenario. And letting others manage that diligence process, that it is extremely time consuming and detailed.
So this has been a fascinating conversation. I know we could carry this on for hours. If we summarize what we've discussed today and how your firm works with businesses, whether the business is struggling, whether they are stagnant, or whether they're very successful, what are some of the in summarizing, what are some of the key points that you would like to bring up?
Yeah, I think from when we look at our firm, we think of ourselves to some extent as a force multiplier. Whether you're trying to grow the business, enter into a new market, expand product, whatever, all of those things take time, energy, and effort, and maybe some expertise that you don't have in-house. We bring our team in as a force multiplier of the business and bring in that experience. We bring in the best practices to let them grow that business and find those opportunities that will help them hopefully even find some exponential growth opportunities. So that's what we do. We supplement. We're C-level experienced, and we bring in that mindset when we come in, and we can relieve a lot of the effort that it takes to grow that business and not lose sight of what you already have.
I like that term, force multiplier. It sounds like a military term. You being in the Marines, is that? But I like it because it sounds like it allows a company to expand their horizons. How did you come up with that?
Well, you're bringing in experience that you probably wouldn't want to incur the expense of on a full-time basis. So it's kind of a right time solution as well. you're only buying that experience for the period of time that you actually need it. So it's actually a very cost-effective way to grow your business as well.
Yeah, your experience and your connections as well. But the thing that's always impressed me about you and your partners is your ability to look at financials, your ability to strategize from the financial side of things. It's forward thinking from what I've seen in conversations where you've had with business owners that I've been a part of. It's definitely a strategy in growing the business from a financial perspective. You can't just simply be a bean counter, right? I mean,
Yeah, correct.
You've got to strategize on where you want your financials to be. Then how do I get my financials there?
Yeah, and again, that's aligning the strategy and vision of the company to the operations. And again, the biggest thing for businesses, and I've been there, you get so caught up in the day-to-day operations, the client here that's having an issue, the customer here that has maybe a customer service issue, and you're so busy dealing with those types of issues on a day-to-day level that you don't look back to the strategy. So aligning that strategy and operation and execution and keeping those things moving in the same direction, that's the way to optimize business. It's very tough to do, as all business owners, and I've been a business owner as well. They like to say, I don't own the business, it owns me. That's how busy they are.
True, and they may not have the internal assets to really carry out the vision. That's why they need a partner like you guys. And you mentioned earlier that, it's not so much that they have to hire somebody like you full time. It's on an interim basis. Let's take a look at your business, where you want to be from a strategy perspective, and let's build a plan to get there, because oftentimes the plan, it's like putting the ladder on the wrong wall. Yeah. I've got this plan, but I'm going in the wrong direction. I can't get to the plan in this direction that I'm going in. So hiring somebody like you maybe zeroes them in on the right path.
Yeah, as I said earlier, we act as an advocate to the business owner. And that's where we can really help them the most. We can bring in some vision, some insight, give some attention to areas in that strategy that they might not have time to do in running the business.
Well,
But
Kirk,
we definitely see ourselves as advocates of that business owner. They can bounce ideas off us. We're independent. A lot of times, everybody's so invested in a company, even with the management teams, it's hard to have open dialogue because you're concerned about maybe frustrating someone or that kind of thing. Our relationships with our business owners, they can freely dialogue with us about where they might want to take the business.
that's, excuse me, that's excellent. And we definitely see a lot of value in this. Like we had mentioned, there's companies out there that really need to take advantage of the services that companies like yours and others provide. And we certainly appreciate your time today. We look forward to continuing this relationship and working together on some projects. And, we look forward to doing that in the future.
Well,
Yeah,
gentlemen, go ahead. I'm sorry, Jeff.
Yeah, thanks so much for joining us. Strategy Partners Group is the name of your firm. We certainly can connect some dots if anybody wants to reach out directly, indirectly. We have a link below to our website. We've got a brand new website up, xroads.com. Really cool stuff. Lots of good information on there, and some interviews such as yours will be posted on there. So lots of opportunities to help businesses. That's the goal here and the objective.
Yeah, we look forward to hearing you speak at the conference or the little association dinner that we're hosting. So I know they're excited to bring you in as well.
Yeah, guys, and I want to say pleasure working with you guys. Thank you very much for the opportunity to speak with you guys today.
Thanks,
Thanks,
Kirk.
Kirk.
All right. Take care, guys.